Hey everybody, it's Lawrence from financialthing.com. It's a Thursday evening. If you're in the UK, Thursday evening, wherever you are in the world, it's our live stream that we do every week. And today we have a very, very special guest. As always, I try to bring you different topics of conversations, different guests. And I finally managed to twist the arm of Mr. Stuart Law from Assetz Capital, who is one of the founders and CEO currently, and we got him live here on the stream. So if you have questions or comments for Stuart, please put them in the chat. We'll go through them as we get relevant questions. Probably won't be able to answer them all, but I'll try to get the most asked questions for you. As always, nothing is I'm sure Stuart will try to answer whatever he's allowed to without getting a slap on the wrist. Sometimes that happens. So let me go ahead and bring on Mr. Stuart. How are you today, Stuart, with Assetz Capital?
Very good, thank you.
Thanks for being here.
Day.
Yeah, thanks for being here.
No complaints.
So we're going to have a lot to talk about. We try to keep the stream less than an hour. That's kind of the running joke on this channel, that we never seem to get under an hour because everybody always has such good questions for us. But we're going to talk about Assetz Capital. We're going to talk a little bit about the peer-to-peer lending landscape in general, what's going on, obviously the impacts of COVID. Another piece of news today that we saw, another company going into administration. So obviously, the idea of where's the safe place to put money these days without taking too much risk for the returns. We'll have a little chat about that. Let me pull up my notes here so I don't ask you the incorrect things. So firstly, yes, thank you, Stuart. And let me ask you, can you give me the date, if you remember, when Assetz Capital wrote its first loan and put it up on that peer-to-peer lending platform?
Well, the giveaway is it's our 8th birthday tomorrow.
Really? So I have to do the math.
8 years ago.
Oh, no.
Yeah, complete fluke. You'd think you'd organise that. But no, 8 years ago. And it was at the time, I think it was three or four times the biggest loan ever put out by a P2P platform in the UK at the time. 3 or 4 times bigger than the previous one at £1.5 million, and it was for a completion funding for a student accommodation in Nottingham from one of our continuing borrowers, Tarjubi. Grown and grown with our support over the years as a business, his property investment side, and 2013 April
16th.
April, yeah.
April 16th, 2013. Now you've definitely come a long way with your business. Just for people that maybe haven't invested, we have about 65 people watching live right now, but we also archive this video, and there'll be people that don't really know much about assets, but most people do. Just tell me very quickly, Stuart, who can invest through Assetz Capital? Is that companies, limited companies can, people outside the UK? What's the general theme for that?
Yeah, we've got our entire history with retail investors. We started with retail because Assetz Capital is part of the wider Assetz brand, Assetz Group, which has been going for a very long time, with the Assetz name since nearly 20 years ago, but beyond that as well. And so we had a very large private investor base, retail community, prior to even 2013, and it's grown. So retail's at the core. Retail's funded $1 billion of lending through us. Retail's earned gross interest of around 150 million to date. So it's a big part of our business. So retail is very much at the core. 40,000 registered investors today. And to answer your other questions, international. You might not be able to do automated ID verification, but otherwise we'll just do it manually where that's possible, and it often is. We've got business, limited company, partnership, whatever. Businesses invest through us. Substantial sums as well, last time we looked. We have institutions who invest through us, and what does that word really mean? A lot of people say, oh, we've got institutional investors and so on. I think there's a bit of a difference between acting as a broker for an institution, which isn't what we do normally. We tend which is a bit crazy because P2P was invented as the solution to banks not lending, and the answer is quite simple, really. What we do is we give them a lower risk way of investing, and other investors, other types of institutional investors, will maybe often take the higher risk element. So some banks fund everything we do, some do the lower risk parts, and other people who need the higher risk and higher returns will fund the slightly riskier junior piece. So yeah, institutions, banks and so on. And talking of institutions, yeah, also the UK government through its British Business Bank, British Business Investments subsidiary, who started off last March with 15 million funding line, and that's grown considerably larger now. British Business Investments' job is to increase the overall supply and diversity of finance to smaller businesses, which is exactly what we do. So they work with delivery partners like us to provide funding for SME, small medium-sized enterprises, and we co-fund with their capital as well. So it's a traditional full-blown marketplace.
Okay,
everybody's welcome.
And as a retail investor like myself, we've seen generally the rates have started to decrease as obviously interest rates have come down. Peer-to-peer lending companies have had to remain competitive. What kind of return rates could retail investors like myself expect to earn through the rest of 2021? And maybe, do you expect those rates to change much in 2022 as far as returns go? Yeah,
it's not that rates of return, interest charged to borrowers has fallen in the crisis, quite the opposite of what you'd expect. What happens is when you're running a prudent business, you have to weigh up all of the inputs and outputs. So if you have, for example, delayed payments here and there, that will slow down interest payments and reduce actual paid interest cash. You could have other situations where the provision fund, which we operate on some of our accounts, would be being topped up to a greater degree, and lots of other factors. So when you join all those factors together, it moves rates. And certainly one prudent move would be to lower rates to make sure that you can pay them reliably, you're not misinforming people with the wrong rates, and that you can top up the provision fund. So it's something that has wobbled a bit in the crisis, but of course that's a very nice thing to say, isn't it? Because when people judged the peer-to-peer sector over the years, the clever phrase was, we've never seen it go through the cycle. There was only Zopa who'd been through the cycle, wasn't there, in the UK? And it's a very clever, factual point to make. Nobody's been through the cycle. So I think if you had an investment that didn't wobble and move around a little bit in the middle of a cycle, particularly something as bad as we've had for maybe the last 300 years, to be honest, that would look a bit suspicious to me. And yeah, we've wobbled a bit. Our rates came down a little bit. You asked about 21. We don't anticipate our target interest rates will change in 21, but we continue to assess them live, month to month, in case anything in market conditions changes. But at present, we don't. They're down from where they used to be, and it would be great if we could give more to investors in the future. We don't know whether we will, but we'd certainly want to. Yeah.
Okay. So obviously, Stuart, your company, Assetz Capital, really focuses on SME lending, which for anybody that doesn't know is small and medium enterprises. We're talking about smaller to medium-sized businesses. And COVID has really put a damper on some of these businesses' operations, really for the last year, coming up over a year now. So how has that impacted the outlook of really Assetz Capital's previous loan book? As I was one of the early sort of loan adopters and picking out manual investments, and I've seen, within my own loan book, that a lot of these loans now are, some of them have run into trouble. One thing that I do always tell people about Assetz loans, because you are reducing capital in some cases, they're repaying interest and capital, and it does reduce the risk on some of them. Now you don't have as big a loan balances outstanding. But generally, I'm sure there's some other people, investors that are watching, maybe looking at their loan book thinking, I'm starting to see these issues with these loans. What is the outlook, for these SME loans moving forward?
Yeah. So in terms of two different questions in one there, really, aren't there? So I think if we start with the main question, the businesses, the SMEs, and how they've been hit by COVID and what that means to the loan book, first of all, generally speaking. So SMEs have had different experiences in this cycle, haven't they? Some have boomed, just like some corporates have boomed, like Amazon. There are plenty of businesses that have boomed, probably through quite hard work, adapting to the changes and done very well. Others have done diabolically awfully, and it varies by sector. So you've got hospitality that we weren't massively exposed to, which has been closed mostly for the last year, hasn't it? One way or the other. Mm-hmm. And is going to reopen. There was a bit of a boom on Monday. Did my bit. Went down to the local pub garden and had dinner. And you can see that coming back. And most have survived. It's a combination of tightening the belt, furlough support for their employees, all the other initiatives for hospitality in particular, and all sorts of other factors. But hospitality was certainly one of the ones that you would expect to have been the most badly hit. And we've seen and been pleasantly surprised by the lack of impact. People have put their hands in their pockets. We tend to lend to fairly well-funded businesses, and many of them have self-funded, didn't even use our forbearance. So it's been okay, but that's one of the more dangerous sectors. And then you look at other sectors, and the housing market temporarily closed. People assumed the builders would stop work on site and it would be a disaster for ages. But the obvious point is, unfortunately, in the UK, we still build these very expensive homes in the middle of muddy fields in rain or shine. Mm-hmm. And so that's outdoors, isn't it? And all the talk at the moment is the common sense that outdoors is, perfectly reasonably safe. It's massively safer than being indoors. So in reality, the wobble on the housing market in terms of construction on site was literally just that. A modest percentage of firms stopped. They started as fast as they thought it all through and applied common sense. And it didn't cause too much of an issue at all, but it definitely paused two things. It paused the ability to construct the houses for a short period, and then it also potentially paused the ability for them to sell the properties as easily, because lockdown stopped quite a lot of sales activity in different ways at different phases of the lockdown. So we allowed for two impacts to house builders. One was a delay on construction, one was a delay on sales. But how has it really then played out? So we've been supportive of those people and given them the flex where they need it. But now where we are today, we've got booming housing market here in the UK. Sales redemptions from legal completions of homes our borrowers have built just flood in day after day after day, and absolute housing boom. Not terribly surprising given what's going on. People now value their home for much more than just the weekend, of course, don't they? Because they're there all the time in many cases. Mm-hmm. So they appreciate more space. People are moving house. People want space, different building configurations, more space for an office. So yeah, it's driving resale, second-hand sales, as well as new build, which we fund. So that market has ended up doing very well in the end, but with difficulties in the middle. And then in the rest of the spectrum, very wide range of trading businesses that we fund, and they too have done perfectly well on the whole, shown very good resilience. So the government support and interventions have worked categorically. The reason they worked is they went fast. And by going fast, you make some mistakes. Some money probably went to the wrong people. Some money won't be coming back. But in the end, the country was saved by that fast intervention. And it's worked well, in my view. So in terms of what's that done to the loan book was another part of your question. There's basically huge numbers of loans repaying now from those strong sales. The majority of businesses are trading perfectly well to very well. We have around 10% of our remaining house building loans at the moment, bearing in mind lots and lots have repaid recently. Of what's left that's still building and finishing off, just 10% of that reduced number is in some form of recovery, and that percent is expected to fall very sharply over the next few months as more and more new loans come back on the books to take us back to a normal mix. So it's modest, it's all property backed, which gives great comfort to people. And the money is flooding back in now. We had 30 million of redemptions cash come in just in March. We had 22 new developments funded just last month. The market's flying. And we've only got a couple of developments that are over budget on time or cost. It was 7 in the middle of the pandemic. So these aren't really terribly shocking figures in the context of a business that's rapidly moving to a 1.5 billion of lending done since 8 years ago. And defaults are the reality of lending. Banks have them when they lend their money out, and you lend your money to a bank, don't you? And they have defaults. It's entirely normal. If you haven't got defaults, what exactly is going on? What's your business? Because there's one thing to be said, lending does sometimes have defaults, no matter what you do, no matter what you say. And that's the beauty of it. Because it's got a bit of risk associated to it, and we then hire a fantastic team to manage that risk as well as we can, it's that risk taking that produces the return. And to my way of thinking, personal view, investment with a degree of managed risk is the entire future. It's how the world is going to get its return in the future. My view is it's not going to be bank interest rates.
No, certainly not. I mean,
so pick your investment platform, find the people who've got the track record, and give them a bit of your cash. It's a very simple message, and the government, the FCA, Treasury, Bank of England, they're all grappling with this thought that investors, to be able to live off their capital in the future, are going to have to take more risk. And our job is to take those risks, manage them well, take sensible risks, deal with what goes wrong occasionally, and do the best we can on that, and give you a great, healthy net return wherever possible, and without too much noise. That's basically all we can do. Real investments without trying to pretend there's no risk.
Yeah, of course. Just an interlude now. If you can hit the thumbs up on the YouTube for me, that helps with the algorithm so other people can see this live stream. We got about 85 people right now live watching you and watching me ramble on. And also subscribe to the channel if you haven't already, but again, hit that thumbs up. If you have questions, please put them in the chat. We'll get to them at the end, so hang out and we'll get to them intermittently. I know there's some people that have some things. Of course, you're always going to have good and bad. You know, when it comes to keeping all the investors happy is not always an easy job. But one of the things I wanted to ask you is, you know, sometimes I tend to focus a little bit on the negative side of peer-to-peer because we've had, you know, me being invested in some of the companies that have gone under, and we tend to have a little bit of a sour taste in the mouth. But I wanted to ask you maybe about a lone success story, maybe of somebody, you know, a business that you funded through Assetz Capital, which has really benefited from having that lending. If anything springs to mind, maybe you can tell me about something that's been a real positive that you've seen.
Yeah, I think positive for us and our investors is impact often. I mean, the interest is great, but what's the actual impact? What's the effect on the markets that we have chosen to fund with our investors? And what's that impact? So, you know, one recent case was Forge Care. It isn't immediately obvious, and we're going to make it more obvious over this year, what the impact is that our investors are achieving with their investments through us. And it isn't just the impact on their bank balance, on their interest. What's the impact on the SMEs? So an example was Forge Care that we did a case study on just recently. That was a £5 million development loan for a specialist childcare development in Nuneaton. As it happens, when coronavirus hit, building work stopped, contractors had to stand down, and the whole thing ground to a halt. But we were going to lose a very, very high quality, very necessary care home, residential care home for 20 children. Highly intensive, supporting 80 jobs. So every local authority needs these. It's a really tough sector to be in and operate, and on top of that, they had to build the thing. So we brought the funding to them, 5 million funding, and they're now going forwards on building this space to revolutionise the way that children's care is provided in the UK. It's a fantastic development with intensive support and care for those children. And that's the type of loan that people are funding.
Yeah.
Another more vanilla type of impact is a more straightforward SME home builder. SME home builders have declined over the decades. There were maybe 25,000 of them a few decades ago. That we're down to about 2,500 SME house builders now, small, medium-sized ones as opposed to the big national brands. And trying to recover those is a big agenda item for the government, but it's an agenda item for us. I mean, if we don't want to build on big greenfield sites in the countryside, we have to do infill sites closer to city and town centres. The big nationals are not going to do that. So we have to push support into the SME house builders and get back from 2,500 to 25,000 over the next few decades again. We're supporting that. And another example was a 700k loan, which supported 47 1, 2 and 3 bed properties in the Wrexham area. Just 700k. 12 of those were affordable, ring fenced for local house buyers. That company, Gower Homes, had built over 750 homes around Wrexham in northeast Wales and Cheshire in the last 24 years. But finance is tough for house building. Mm-hmm. It's not easy. It's all right if you're a national, and it's all right if you can self-fund the odd single house and you've got plenty of money in your back pocket. But the minute you start getting to slightly bigger, the market dries up for the funding. That's the market we target. And we're trying to drive money into those established, proven smaller house builders, plenty of track record, who with more funding could just do more. Mm-hmm. And doing more helps solve the housing crisis. So again, the investors that we have on our books, they're the heroes. We're just a channel. We're just a way of people deploying their cash to help solve problems in society and earn a great interest rate to boot. Mm-hmm. What's not to like?
Yeah. It's nice to hear, some positive stories about how we often all we see is the loans that are put up on the peer-to-peer lending companies. We don't always see the faces behind those borrowers and what their stories are. So it's nice to be able to be reminded of that. But I wanted to talk to you about the, obviously 2019 up to where we are in 21 has been really hard on this very young peer-to-peer lending sector. We've lost some companies, obviously. I know you won't talk specifics about what's happened with those, but we had in the news today another one that has gone into administration. Haven't really had much chance to dig into the ThinCat situation, but has the closure of these other peer-to-peer companies, and of course we got RateSetter exiting out of the retail side of things, which I knew was going to happen. Has that helped or hindered Assetz Capital as far as trust? And one of the things that people are saying is, how do we trust now at this point with so many of these companies that have closed their doors? Have these closures helped you or hindered you, do you think, Stuart?
I think in the medium term it'll be very helpful, but for us at least anyway. I think what it's done though is it's just brought realism to the market. Whenever something new happens, there's always that moment of everybody thinks it can walk on water, it can do anything, and it's also early days in loan books as well, so you don't have defaults. And also it's early days in this industry in regulation. When everybody started, there was no real regulation, and then regulation came in super light touch. Now it's much fuller and more comprehensive, and as markets mature, they narrow down to a few successful players in the market, and it's just basically shown who was swimming without shorts, basically, whether we knew it or not. And some of those names disappearing, even the one today, are very surprising. Others are definitely not surprising, and you've been watching and waiting over the years. It's just obvious. I've been in business for decades, so you can always tell when a model looks strange or unsustainable. You know how numbers add up in business, and sometimes they just don't seem to add up. So you know something eventually will come out. It's a bit like when returns are in a straight line. We saw Bernie Madoff die yesterday, didn't we, in his 80s, and he had a perfect straight line investment return. Nothing ever wobbled it.
Yeah.
People thought he was a miracle worker, and in reality, of course, you don't get straight lines in investment. Investment has risk. Mm-hmm. You get ups and downs, you get cycles, you get things happening. How you handle those and control the wobbles, that's true business. Straight lines don't exist. So I think a number of those platforms that have gone over the last few years, some of them had the equivalent of straight lines, they had no visible risk, but you always ask yourself, what is it I don't know? Because everything has risk, everything has things which don't create straight lines. The minute there are straight lines, you know there's something you don't know. You just don't know what it is.
Yeah, absolutely.
I think that's really, with hindsight, it wasn't too hard, I don't think, for most people to have seen what was going on. But unfortunately, it was a new sector. It was very hyped, and people thought it was perfect. And it's not perfect. It's just real world lending, as we say every day.
Right.
Real world lending has some noise, but equally good real world lending produces positive returns every year. And we produced, even on our lowest paying interest rate accounts, the Access accounts, we paid around 4% all the way through last year. And what's not to like about that?
Yeah, absolutely. So obviously you've paused new lending for a while due to COVID, and I think a lot of people are wondering, when is Assetz Capital going to get back to its regular lending pre-COVID time? What's your thoughts on that at the moment?
Yes, yeah. We're at the moment we're out originating loans. Quite a bit of it depends on the Access accounts. So I think maybe some stats on the Access accounts will set the scene for why we paused partially, because we've prioritised getting money back to investors who worried about what was going on in the world. And what do people do when they worry? They huddle over their cash, don't they? And they put it under the mattress and they do what they do with it. But of course you don't then earn a return, do you? So what we saw were quite a few big gyrations really last year. If I give you a number of stats, for example, it's about a year ago that all this kicked in, 13th of March, in fact. And since then, we've paid out around £150 million of cash to people who've withdrawn just from the Access accounts, never mind all the other accounts. 150 million cash gone back. Admittedly, quite a lot of people wanted to see if the money did come back and have put the money back in again. So the accounts haven't shrunk by any means by 150 million, but we have given the cash out. And the queue, there was a withdrawal queue. It was there for about a year in the end, it looks like, in the worst cycle in 300 years. And of course there would be. That's what we said in our information on our website. If we ever see a really crazy economic period, liquidity will dry up. But that doesn't mean anything's changed on the loan book. The loan book quality will then be affected by what's going on in the economic period. And it's held up perfectly well. But what matters is that the queue to get out, when everybody was so used to millisecond type withdrawals from the Access accounts in the past, was a bit of a shock to people. But 150 million out, pretty much nothing left to go. The queue is nearly zero and might well be so in coming days. We've said it might be a few months, but it could equally, quite possibly be just a few more days, the rate it's going, because we're paying out millions a week. And there isn't very much left. So in the coming days or a week or two, maybe we'll see the queue is zero, and then maybe people start putting money back in, and off we go again and grow. And the Access accounts haven't shrunk that much in the end, and we expect that the track record through the cycle, which is what everybody's been waiting for, the clever comments, what does the business do when we hit the next economic cycle? And just for fun, we got given the worst one in 300 years to play with as the first real one for the sector. It's had its casualties, but those that come through the other side have had their business models tested. And it was difficult, but we navigated it. We have a lot of experience. As I said, I've got decades of experience in business, but our team is a bit grey around the edges, and they too have seen it all, firsthand in their own businesses or managing the funding books that lend into other businesses. We've seen it all. So we were very, very quick to react, very quick. You're talking instantaneous. And we knew roughly what buttons to press, generically. We had to adapt that to the situation and to our particular business at that moment. But when you've been in business for a long time, you know roughly what you need to do. You need to manage your costs, you need to manage your income, You need to look after everything that's sort of loose and flying around in all the chaos. Bolt everything to the ground and just stabilize everything. Find a floor, and then come back from that floor and go back into normal business again in due course. Everything always reverts back. You just have to survive the bad period, and you have to lock down risk, be very careful, stick to a very tight plan, come out the other side, because you just don't know how bad it's going to be, do you, until afterwards. So we assumed the worst, did everything that was necessary to survive the worst, and then it wasn't as bad as all that in the end anyway, was it? In the end, economically, it was pretty bad for some. Some have had really bad times, and we've had plenty of businesses, unfortunately, go bust. We've had the huge medical impact as well, with countless people losing their lives and becoming very ill. But in the end, it could have been much worse. Could easily have been much worse. And I think the worst fears have now gone, and people are much more optimistic that there is a better version of what happened before ahead of us now.
Yeah. So is it you always have this balance problem of having enough money to deploy from investors, like retail investors like myself, being able to write new loans. Is the pause on new lending really dependent on how much new money is coming in onto Assetz platform to be able to write new loans, or is it based on you treading carefully to write new loans?
No, we've got more than enough capital to lend out from a retail perspective right now. Tens of millions on the platform ready to go. We've got a pipeline coming, and it's all progressing forwards. So we've got into that position, but until now, the money has only done two things. It's looked after the loans that people were already invested in, which is very important. You can't just abandon borrowers mid-development. You certainly couldn't let a few people out without finishing off those schemes and let a few people out and leave everybody else carrying the can. So we had to manage the money in a way that looked after people's current investments. We stopped doing any new lending from retail on purpose in order to then maximize the money that would go back to investors as well. So we looked after existing borrowers and then fed as much money back, which people can clearly see at the moment is flooding back into their bank accounts at a rate of knots at the moment with all the redemptions. So it's all about giving people the cash back until there's no queue, which is imminent, and dealing with looking after our borrowers, because in the end, that is everybody's issue. If that becomes a problem, it's everybody's problem.
Right.
So you don't just abandon people. We're in the business of lending, and you lend through to completion. You don't do a runner in the middle. Bad things happen, particularly in development, if you stop halfway. So no, we didn't do that. We didn't do it to one penny. We never missed a single payment to a borrower. Dealt with the whole thing completely. And there were some big numbers involved, but we managed it because we had systems, a bit of good luck given how bad the pandemic impact was on the economy, but a huge amount of self-created luck through the team we had and through the work we did, and also the support we had from our investors, who voted very quickly to look after borrowers, protect their value in their loans by looking after borrowers to a degree carefully, which we did on their behalf. And we just did our best to protect everybody, all of our stakeholders together, which is our mantra.
Yeah, that's a good mantra to have. If it's all right, we'll just kind of answer a couple of questions that people have been writing into the comments here, Stuart. Let's have a look. We have a nice a comment here from Margaret, who says very happy with peer-to-peer. Let's see. She said that she also invested through Seeders. A lot of people, I really don't think they understand how Seeders works and shares and maybe the valuations, but she was wondering what new exciting things does Assetz have planned to grow. So maybe that the shares that she paid, I think £2.35, she said, for, are they ever going to rise through Assetz's new innovations or growth of the company going forward? And obviously we don't know if those share price will ever rise, but
well, the job of a board of directors in a simple company is just to grow shareholder value and have an eye to other stakeholders when they amended the governance rules in the UK and the US and so on a while ago. A number of big companies signed up to that idea of wider stakeholders, but in reality, most companies are just focused on shareholder value. My belief is that if you look after all your stakeholders, including your shareholders, you'll deliver the best long-term sustainable shareholder value overall. So it's not about continuously driving a shareholder price, because that normally comes at a cost. It's a cost to your customers, a cost to your staff, a cost to somebody somewhere if you're biasing all your return purely every day into purely shareholders. So there's a lot of very good studies show that the biggest shareholder returns are from the companies that have good balance between looking after all stakeholders over time. And that is absolutely our mantra. That's what we mean by fairer growth for all. Keep in the sweet spot. Over time, stay within the middle and balance the returns to everybody. So I think what Margaret is saying is the last share price where there was a transaction was at £2.35. It's been that for a little while. And when is it going to move up again? We're not massively aggressive in pushing the price if we can't justify the value ourselves. I know some people do that, and for some, it becomes like a self-perpetuating chart, doesn't it? Mm-hmm. A bit like, say, GameStop, if you want to name that. But there are big things afoot. So with our move to greater institutional funding this year, with retail funding coming through to the other side as well, and with quite a number of other initiatives, we absolutely expect substantial shareholder value. I'm not just speaking as a major shareholder. I mean, bear in mind our management have getting on for half the company as well. So aside from myself and my family, the management have about half the company as well. So the shareholders from Cedars are in good company. There's some very, very motivated people looking at medium to long-term shareholder value, not just this particular year or month. And everything with our management team is biased towards share price, which you only get over the long term. So we're all about long-term thinking. And I think we're hoping that in the next year, at the most, there'll be quite a few things happening. So we'll probably be raising money this year. We'd like to be raising that at a substantial premium to that particular price. And we're aiming towards an IPO in about 3 years' time as well. And to be able to achieve that would give liquidity to the Cedars investors above and beyond the Cedars secondary market. And it would also see likely a premium above the current private company valuation at the moment. So as a company, we're most definitely seeking to put multiples on the current share price. Multiples within only about 3 years' time. And we'd expect to see that in a couple of steps or so along the way. So we're very bullish, and as a major shareholder, myself and my family trust, charitable trust, we are most hopeful that the share price will go up. We can't obviously guarantee it, and we can't give guidance, but I've got a big stake in that. And our management team doesn't take big salaries, and we don't pay bonuses. So it's all about the share price and delivering profits and long-term value. So yeah, I'd certainly be sitting tight on those.
Yeah, I would say exercise patience is the key to any type of investing.
It's a lumpier thing, investing in equities. You can have some nice straight lines sometimes in equities, but it's it's going to end someday. With businesses who don't have manipulated share price, let's say, then you do tend to see plateaus and moves and plateaus and moves backwards as well as people get confused. But my job is to try and give clarity on where we're going. We're moving into profitability, and we expect in the next 2 years to move into greater and greater profitability. And we as a business will not have no intention of valuing off eyeballs, valuing off all those different things other than profits that people occasionally try over the years to justify a crazy valuation. We're going to go for a good old-fashioned multiple of profits. And it's quite possible, after we've IPO'd, quite possible we'll become a dividend-paying company. And a very healthy one too, with a very rapidly growing dividend. So that's our intention. Those sorts of businesses with with inflation coming this year, I believe, personal view,
Mm-hmm.
and carrying on for maybe the next 2, 3, 4 years, but with central bank response to that being very muted, so very minimal increases in bank savings, I think the need that people have for yield is just going to carry on increasing.
Mm-hmm.
With higher inflation, it's going to get more pressing. So our job is just to carry on delivering return, and we'll deliver it through the platform to retail investors as they do today. We might well list and pay dividends then, and we might well have other investment vehicles and funds that are on the stock market that people can get dividends from as well. So our entire purpose for investors is deliver great healthy income. That's what our entire business model is about. And if we're doing that in years to come, and even today, that's a hugely rare thing. Everybody's seeking yield, and that's our job, to deliver yield with great risk-adjusted returns. That's all we can ever aspire to.
Right.
That's all we can ever. And I think that's a very valuable business if you can deliver that. We've got 8 years track record in doing it, and we will do everything we can to carry on doing it. That's what we're doing. We're not going for speculative share price. We will be valued by just delivering great returns to people.
Mm-hmm.
That's it.
Okay, so hang on to your shares, I would recommend. Stuart, one thing, so I don't know if you can see on your end, but your video is frozen. I mean, your audio is coming through fine. I don't know if it's something with Skype on your end.
That's interesting.
You might want to just try turning the camera off and then, don't disconnect the call, obviously, but just turn the camera on and maybe start it up again. See if that helps. There you go. He's back.
Well, I had that before. Yeah, we use Teams all the time, and it doesn't tend to happen on Teams. So
yeah, it's
there you go. Maybe it's a Skype thing more.
One of the Skype bugs. So let's talk about. So obviously you've been through this time of where we've had this pause. I want to ask a question about how Assetz Capital was able to continue operating financially, and maybe you could talk about the profitability, and then we're going to get to the announcement of this 1% withdrawal fee that was announced a few days ago, which I'm sure has given some groans and moans, and people want to hear about that. But let's talk about first of all, the profitability of assets. I know you've had times where Assetz Capital has been profitable and when it hasn't. What's the current situation about, are you heading towards a profitable run business, or has COVID really set you back in that respect? And how have you continued to be able to operate financially with this long pause in loans?
Yeah, I'm an old school businessman, I'm afraid.
Yeah.
And profits are sanity. So we've always wanted to make profits, but equally, when you've got a startup business, you need to invest in it. Very rare business that just makes money the minute it starts, and probably not a business that can scale, because it's going to find it difficult to do that. So we set up 8 years ago. We've invested around £10 million in the business and produced a business that's getting on for £1.5 billion now to date. That's quite a shocking number to people who are in the business, because that's a fantastic business scale to achieve from that level of investment. But yeah, investment is the word. It means that when you raise money for the business, you definitely do invest it. That means you make losses until it comes back as profits in the future. And one of the things investors never know, look at the Deliveroo flotation recently. Look at everybody. Look at Amazon over the years. Amazon was losing money like crazy, and everybody was thinking it'll never make money. But eventually, economy of scale and pure scale and efficiency and lean operation that comes in through that level of scale comes through in a sound business model, and off you go. So what you have to do in the early years is focus on your gross margins. You need to have gross margin to pay overheads. I've seen some very peculiar businesses where the gross margin they bring in doesn't even barely cover marketing budgets, for example, and never mind the wages. So very odd. So we've always been producing money, but we've invested most years more than we've brought in. But our losses are very modest. 8 years of operation, and we're probably running about 6 million or so net losses from investment in getting the business up and running now. It's next to nothing. And we've done it because we've been very, very tight on costs. And we're tight on costs because that's how you do it. we've all seen the companies that raise millions, hundreds of millions, tens of millions, and then just burn it on private jets and parties, and it just vanishes overnight, doesn't it? We set the business up and got it working with an initial £1 million that we put in, £1 million cash. We ran a super tight ship. And so we've always had very tight cost control. So going back to your question, to a degree in the cycle, potentially we could have had very big losses, and we had plenty of money in the bank, but you need to deal with that. You need to make sure that you don't just leak money, because nobody knew how long it would go on. And when you don't know, you have to take extreme measures and be very, very careful till the data comes in and you've got better information. So that's what we did. And we tightened right up. We immediately took steps to pause new lending, to make sure that everybody's money was only funding the existing loans they were committed to, for example. We made significant cuts to directors' salaries. We had other voluntary cuts across the board on staff. We made use of the furlough scheme and so on, just like huge numbers of other companies around the country. And we just basically acted extremely prudently and were very, very careful and huddled around the cash we had whilst the data began to come in, and we began to form a view of what the world would look like over the next year or two and what that might model for our business. And when you don't know what you don't know, you don't act wildly. You don't just carry on spending a ton of money and pouring money out the door. So you really batten down the hatches until you've got enough information. And we got that information very quickly, and within 90 days we had a fully implemented plan. Within a few days we were starting to make cuts, but we also introduced a temporary lender fee, which is drawing to a close this month. That's over. As well as a few fees to borrowers for dealing with all sorts of additional stuff they needed us to do as well. But we also had very good income from the book. We're not just a company that earns money from new lending, but it wasn't entirely enough to cover all the business overheads if you stopped lending entirely. So we had to deal with these other matters as well. And Sybil's getting accredited by the British Business Bank and becoming a Sybil's lender also became an important income stream in 2021. Mm-hmm. And finally, we also, nothing to do with profits and so on, but it's helpful for cash in the bank. We also did a fundraise via the crowdfunding platform Seeders again, and also the government's future fund, just to basically bolster cash reserves and make sure that we were as solid and deep-pocketed as we could be. Okay. But in the end, it's down to the team. The team just pulled together and nailed it. And you didn't know what you were nailing at the beginning, did you? It's like trying to nail jelly to a wall. Very difficult, but we did it. Yeah. And we're up to the side, and the impact on investors has been a loss of liquidity for a year, which was predicted and bound to happen anyway, because as a business we don't provide guarantees to liquidity. If we did, we wouldn't be able to pay the interest rates we pay, just like banks can't, and so on. So we did the best we could. We've come through the other side, and we're perfectly healthy.
Okay, thank you for answering that, Stuart. John Day has asked, regarding the new withdrawal fee that's starting in May, there was some question about what is considered normal market conditions. That wasn't really explained in the email.
No, we didn't repeat it. No, we didn't repeat it because it's been on our site for a long time, and it's the same definition. So normal market conditions, you can generally think, if everybody goes into panic, if everybody starts selling everything and putting their money in a bank or under their mattress, you're probably in non-normal market conditions. And that's a simple way of describing it. Mm-hmm. Does the economy freeze up? Does money stop flowing around? Are there credit situations? Are we in a recession? Are people panicking on the streets? Are crazy things happening with society or the economy? These are all really big things. So basically it boils down to, our expectation is non-normal market conditions are that 1 year in 7, that 1 year in 10, that is the recession. That comes all the time. It's never going to stop coming. I'm not going to do a Gordon Brown and say no more boom and bust.
Yeah, please.
I'm afraid we're on the cusp of what's going to be one of the biggest booms I think the country's ever seen. That's already started, and we've just seen a near bust this time last year for the economy that was saved fundamentally by the government stepping in so firmly. And we did nearly see bust in the last cycle, didn't we, in the global financial crisis, where the whole financial system nearly collapsed. That most certainly did not happen this time, because the government, and in the broadest sense, the Bank of England, the government, and all their bodies around them knew what to do this time. And we knew they knew what to do, and we knew they were going to do what they did, because that's the world we now live in, where central governments look after the economies when big impacts hit, like this pandemic did, and they just get the checkbook out and they sort it. That's what it's going to look like in the future, I think. And we were ready for that this time, and we'll be ready for the next one. So normal market conditions, to answer the question again, is typically those recession cycles. There could be other reasons why, and there's some very detailed description of the various scenarios within the definition of non-normal market conditions up on the website. Okay. But it's basically when it all hits the fan, basically. And it doesn't do that very often, does it?
No, so hopefully
when
not.
It does, surprise, surprise, liquidity is going to be a bit lower. But to go back to the point about the fee, very important point. We are probably the most transparent firm there is on the market. Sometimes it's said that we're not, but I'm telling you we are. One of the reasons we get a lot of flack occasionally is we do change things, we do adapt things, and we do keep telling people what's happening. And in our business, in the peer-to-peer sector, we're not licensed as a fund manager. We can't sort of put a veneer on everything and manage people's money discretionarily and do it all in the back room. It's all exposed. So whenever we have to plan ahead, we're just trying to be as transparent as possible. So to be really clear about this fee, the new fee structure is implemented in May. No one's getting charged anything. This is something that we're just being transparent about for maybe 7 or 10 years' time if the next cycle is in a similar length of time to the last one. And this is a very modest fee as well. And in all likelihood, in 7 to 10 years' time, do we even need to charge it? We were just coming out of growth phase, out of startup phase when the pandemic hit, which is why we had to put in place a degree of fees. This fee is there just so we're open. It might happen. It's always said so in the T&Cs, but it says even clearer now. And do we think we'll apply it in the next recession if it's in 7 years' time? I would sincerely hope we don't have to. But will it impact on anybody in May, June, July, August? We have no expectation of that at all. So no, it is a potential fee in the future that is very transparent. It isn't very much. It's a lot less than it was in terms of income for our business. And it's there just in case, because all stakeholders need to be looked after in a cycle, in balance. We can't just preference one, and the company is one of them. If we're not there, who's looking after the investor money?
Yeah.
And we can see what's happened to platforms that have stopped trading. No matter what the good intentions are initially, eventually the loan book becomes a bun fight for who's going to take the most money out of the loan book, and it harms people's returns. So we absolutely have to look after the business, because that's absolutely looking after the investors and the borrowers. It's got to be in balance, even if it gets a bit imbalanced from time to time in the short term. In the medium to long term, one of my personal accountabilities is keeping that balance on average down the middle between all the stakeholders. It's the most sustainable type of business.
Yeah, I totally understand that. And I've always said, I'd rather pay a fee to a company and have them survive than to the worst happen than what we've seen with the other companies where we can expect these capital
I'm very
losses.
sorry we had to do it. I'm very sorry we had to do it, because the pandemic came when it came. We were just coming out of the end of our startup phase towards the end of the 8 years, well, 7 years at the time. And it just came a little bit too early, maybe a year or so early. But these things happen. That's life. And so we're very sorry, therefore, that we did have to do this. And I'm sorry for our investors, but they still earned a good return, and it will keep on coming for years and years to come, we would hope.
So can you just explain a little bit, as I think there's some confusion about this new fee that has been introduced, and we've had quite a lot of people in the comments saying that communications aren't very clear about what the fee is, and we're talking about the fee on the quick access account, also on the 90-day and the 30-day and the 60-day accounts. What is the fee exactly, and is it actually in place now?
No, it'll come in in May. It is a theoretical fee because we expect we'll be back in normal market conditions by May potentially, or very close to then, if not even April. So the likelihood of anybody being charged that fee is looking pretty minimal at the moment, this time round at the moment. So I wouldn't have any expectation of having that charged for any material period of time. How it works is quite simple. It runs on the Assetz account. It's 1% per annum. However, it's time weighted. So firstly, as you said, the 30-day and 90-day accounts have this fee as well. But if you're in the quick access account and your money comes out in a millisecond, you're not going to have any measurable charge. There's not going to be any charge. You're going to be able to count. Calculators don't go down that low because it's 1% per annum. If your money's out in a millisecond, there's not going to be anything. It's going to be zero, isn't it, on your statement? So when it kicks in is not when you're in the notice period of 30-day and 90-day accounts either. So serving notice does not cost you a fee either. So it only happens if the withdrawals are taking too long and the whole market's clogging up. And what this fee is intended to be is an upfront explanation of a system that would kick in if we hit non-normal market conditions in the future, which I've said is potentially the next recession, as one example of that, probably the main one. And by then, if we did need it, here is how it will work, and it'll charge. So if it took, for example, 3 months to get your money out after serving notice, on a time-weighted basis, that's a quarter of the year. You'd have a 0.25% charge for that, which compared to our interest rates is negligible. But it's important. We don't want to charge it, and I do not believe people are going to have a charge for that. In all likelihood, the way the queue is going, from the day it starts, we probably don't have a need for it to be charged at all. And it may well, hopefully, remain so until the next cycle, I would hope.
And so if that fee actually does kick in, is there some kind of communication that will go out to people saying we've decided that market conditions...
It's automatic, yeah. In many different ways, we need to always remember that we're not a discretionary fund manager. So everything we do is automatic. It just does what it does. So if we trigger non-normal market conditions, there are ways that we know we're in that. And we also published just recently the automatic operating levels, which we had systems for in the past. We've just basically given people a very precise definition. If somebody wants to read that, and it isn't simple, because we run a complicated business, and we've got to think of many different factors that go into the equation. If we didn't, we would just be winging it, frankly, and we aren't a company that wings it. So we have quite a detailed automated operating levels mechanism that we've talked about in the past. The minimum operating level was a part of that. And we've just given out the mathematics and how it all works. And what it's to do with is forecasting future commitments for lending, forecasting inflows and outflows, and looking at any queue that exists. And what it all does is tell you if things are operating normally or not normally. And that's it, simple as that. And if it moves into the territory of not normal, the fee might kick in. And we're just warning it will, in all likelihood. But will it in 7 years? That's what I keep saying. We probably don't need it in 7 years.
Okay. Talk to me about what you think the general outlook of the peer-to-peer lending sector is. Do you think that we're going to see this contraction continue of these companies that just can't operate the way that they have been? And then secondary part to that is people say, new investors, how do I trust maybe somebody that's been invested in Lendy, Funding Secure, the house crowd now we've seen? How do they trust Assetz Capital? And why should they trust Assetz Capital?
Yeah, well, Assetz has been around a long time. We've this isn't the only £1 billion business in our group. Never mind what else we've done over the years. So, I've been in business for decades, as I keep saying, and it's about the team, but there are plenty of things as an outsider that you can look at. We've seen one company recently fold, unfortunately, and they were said to have 8 employees and 5 consultants. Firstly, consultants, big red flag. Everybody always asks, do you have consultants? Consultants aren't as wedded to the business, aren't as deeply enmeshed. They're there for their day rate. So that's never a good sign. And also the scale. That was quite a big business that only had 8 employees. I just don't know how you can run a business like this with this level of regulation properly with only a few employees. Mm-hmm. Can't do it. So we have 120 and growing rapidly, and we struggle with the amount of work to stay absolutely on top of regulation, risk management, governance. The list is long, very, very long. Running a professional business in a regulated world, in a well-governed way, is a big business. So size of business, how many people do they employ? Are they consultants? And lots of other examples. Do the numbers look a bit too smooth? Do they ever have any wobbles? Is everything just perfect? Is it always 1% a month? If there's one thing we know for certain, I've got a bit of a mantra about guarantees. Guarantees are something that can bring companies down and bring segments down. Bank guarantees almost brought down the banking industry in the financial crisis, didn't they? Because the bank guarantees, FSCS, people were running for the door and guaranteed you can't lose money, but they were still running for the door. And those guarantees can produce serious issues. Pensions are guaranteed, annuities are guaranteed. Look at the pain pension companies are in trying to generate the income to pay those guaranteed pensions. Mm-hmm. Guarantees are a dangerous thing. I think they're the most dangerous thing in the whole of the financial system. So we just want to deliver real returns to people, and that's what we're setting out to do, and we'll just do the best job we can. And I think that's what I'm saying. 1% a month, flat, forever, nothing ever changes, warning sign. And there's a long list of those warning signs. Have these people been in business before? What have they done? What scale? Have they managed people? Because it's all well and good running a small business with a few people. What happens when there's bigger people? Companies go through pain periods and ceilings as they grow. I can tell you from personal experience over the years, going through 150 people, going through 20, 10. Every time you grow, the systems you need, the governance, the processes, it all changes and evolves. Have people got experience doing that? It's a tough gig building a big growing business which devours cash, managing the cash flows, managing the people, managing the customers, managing the whole thing and keeping it running smoothly. It's a tough gig, and it's not surprising most companies fail. So we've just seen over the years, over the last decade, the building up of this industry, and unsurprisingly many people fall away. It's unsurprising, it's normal, every industry is the same. Just need to be very careful who you're picking and pick them based on the quality and track record. How on earth do you know that before they got track record? That's hard. That's why it took us ages to grow to this scale, because people are slow with the trust. But we at least had history. A billion of income producing property to our Assetz customers on the buy-to-let side since about 1999. That's a lot of property. It's a lot of income from buy-to-let property for people. Mm-hmm. It takes a long time to do that. And so we had a lot of track record already, we had a lot of trust, and that's why we managed to get to $1 billion of lending from retail-only sources, whereas many people didn't get there. It's tough. You do it one or two ways. You've either got the trust and the confidence of your customer base already, which we did, or you buy it through mass advertising, which we know, don't we, from platforms admitting it, that is just not cost effective. You can't build a brand paying for advertising at current costs. Mm-hmm. Just doesn't work. You end up just cash burning, don't you? And then you run out of money. Yeah. That's the end of that. It's a very tough gig running businesses, and P2P is no different to any other.
Yeah.
You just need to go into it with your eyes open and make sure you're well capitalized and you've got the right experienced team around you, and that it is absolutely a team. Another warning sign: how many directors are there? When our business set up, it was nothing but directors. We hired the top team before we hired everybody else. One of the big warning signs for all sorts of companies failing over the years is governance. How do you have governance if you only have one director? How do you have governance if there's no challenge? We've got a really tough crowd. I don't mean our investors, who are great and challenging and keep us on our toes. It's great. We enjoy it, and we don't like it if we mess up, We apologise, I'm sorry, but we are held to account by our investors, that crowd. But what I'm talking about is the board of directors. We've got a big board of directors, deeply experienced, many of them ex-bank directors and very, very experienced in big businesses. And these people challenge me and I challenge them. We have a very healthy debate. That's another big sign. What type of board of directors are there? Is one person calling all the shots? When you start looking back, or is it a couple of school friends? When you start looking back over the ones that have gone, there are many common themes. So you never quite know what bullets are coming at you, but you can put on the armour, can't you?
Mm-hmm.
You can put on the defences. And that's a combination of experience, prudence, governance, and so on. And it massively reduces your risks. You can't eliminate all risks.
Mm-hmm. Yeah, totally agree. Okay, a couple of challenging questions for you, Stuart. I know you can handle these, but again, I think these are investors that are asking these questions. The Ace of Spades says he doesn't feel like Assetz Capital is as transparent as it could be in the fact that you don't publish the size of the withdrawal queues. Is there a reason for that, and will you consider doing that in the future?
Yeah, I think what we've had is a difficult period, and we have to somehow there is often to many problems never a perfect answer. So we have to debate and argue what is the minimum damage that can be done as well sometimes. And one of those is, do we just tell people there's a decent sized queue of X, or do we just manage it and get rid of it as quickly as possible? And the decision this time was it probably doesn't really help, and it'll probably harm, was our view at the time, the people who need to get out, because others, it's human psychology, isn't it? Mm-hmm. When there's a run on something, and we had a bit of a run, but it wasn't massive, but it was a measurable run. When you have that, people who don't need the money start asking for it back as well. They'll wonder what to do with it when they've got it, but they'll start doing that as well. All it'll do is slow down the cash flow for those in need. Mm-hmm. And some people didn't pay attention to the risk warnings and got themselves in a bit of a pickle over the liquidity. And it wouldn't have been very fair for them if we'd have done something that had caused them to have been paid back slower. So it was one of the decisions we made, and it can't be a perfect answer, but we did our best to do the right thing. That queue has now gone, and there's so many contributing factors to what was the queue. How many really wanted the money back, and how many just put it straight back in and were just cycling it? For example, with the market, some people were taking money out and putting it straight back in again. And that trading, like any market, like the stock market and the bond markets and the currency markets, it's all about liquidity. Liquidity brings down the discounts, and the discount just collapsed over time due to that liquidity. So those people trading in the secondary market really helped get people out who needed to get out rather than wanted to or were playing the trading game. So it was a careful mix of things, none of which was a perfect answer. Mm-hmm. But overall, I think it's helped us get to the fastest elimination of a decent sized queue. And we have, as I said, paid out 150 million of cash in just over a year. And we've near enough eliminated the queue now as well. But the queue wasn't 150 million. There's a lot of money going around in circles. So we could have told people, but what would that have done? It wouldn't have helped.
Yeah.
What mattered was all of our focus into getting redemptions back, firstly protecting borrowers, and then getting the redemptions back as fast as we can. And just look at all that money flooding out into your accounts now. It's coming because we've finished the phase of dealing with the existing borrower requirements. All the money, 100% of the money is flooding back now into people's pockets. And the queue is vanishing at a rate of knots, as I said, many, many, many millions per week. Mm-hmm. And it's pretty much gone. And then we're back to some form of normal operation of the access accounts again, with potentially normal liquidity or something very close to it like it was again before. So it's always very difficult. And transparency, yeah, you look around the world and it's a difficult one, isn't it?
Yeah.
It's a very difficult one that honestly isn't a perfect answer. And we think we did a version, a permutation of things that we did that produced, in the end, a great overall result with hindsight for the maximum possible number of stakeholders. And you could have done it in different ways. Possibly some might have produced a slightly better answer, and a lot of them would have produced a worse answer. So I think, on the whole, looking back, I'd hope that people on the whole think we did a reasonable job. Yes, we could communicate better. Yes, we could tell people more, but would it do more harm than good as well?
Yeah.
And there has to be, in the end, a cut-off between pure transparency and a degree of managed transparency.
Yeah.
It's like the question of benevolent dictatorship, traditional democracy, and full-blown opposite end of the scale, whatever you want to call it.
Yeah.
So, there is no perfect answer. There's no perfect economic model, society model, country model, anything. All you can do is be judged with hindsight. Did it end up working out pretty okay? And people panicked for a bit, but in a way, one of our jobs is to protect against the panic. Now, there wasn't a lot we could do in the early days, but creating greater panic would have created greater harm. And one of the benefits of our type of investment is it is illiquid, naturally. The liquidity is when the normal market conditions are there. And it's very, very important. The property market has dealt with recent recessions very well. One of the reasons for it is that it's quite illiquid, and it takes a while to react. Peer-to-peer lending, and particularly secured lending, has many of those characteristics. One of the reasons it wobbled a bit, our interest rates dropped a bit, but nothing dramatic, and it's all perfectly okay. One of the reasons for that is the illiquidity of our asset base. So the negativity of not being able to take your money out feeds back into it is an underlying illiquid asset, and that can be really helpful at times because it suppresses sudden things like stock market collapses and so on. You don't get the volatility that you get in a stock market, and that's one of the attractions for people. Steady income and pretty much no volatility in the capital historically for any of the established players. There's always risk of it, but we've done a good recession, frankly, haven't we, in the last year?
Yeah, I think so. Just to give you a little positive comment here, because we do have some people saying some good things about Assetz Capital. Brian has said he's been very impressed with Assetz management team. When the pandemic struck, they acted fast and decisively, and they chased borrowers down who defaulted. So a bit of a thumbs up there for you, Stuart. I wanted to throw some of those in for you, give you a little bit of a nice little pat on the back.
We like that, but we don't shirk from the negative feedback. The negative feedback, whether it's fact or perception, is still real. We still need to deal with it.
Of course, and I can imagine it was incredibly stressful for you too, as an owner of a business, and you have so many employees, and people I don't think understand how much responsibility there is on your shoulders to make sure that the company does survive and that those people keep their jobs and they have families. And I can imagine that was a stressful time for you.
It's not like it used to be. If you go back 30 years, I do remember once driving into the car park of my business, and I just, for the first time, clocked all the cars parked in there, and I just felt it go across my head. I'm paying for all those cars.
Yeah.
I'm paying for everything. I'm paying for all their lives. And I do remember that moment about 30 odd years ago. I don't think it anymore because it's now what you do. But I do remember the very first time I clocked that, and it's a big responsibility, and you're trying to manage them as well. And weirdly, at the same time, they're trying to look after your investments.
Right.
The effort they put in was massive. The day and night work they did, 7 days a week, was insane. And they took a pay cut. It was, the team coming together was inspiring, fantastic to see, and very humbling.
Yeah, absolutely. So have you had a lot of complaints, through, say, the FCA, or have you dealt with any issues as far as people complaining about the way the business is being run and then the charges?
Like any big business, you do get complaints. People have got the right to complain, and we deal with them all. Most false complaints are upheld in our favour. which isn't a pride thing. It's just a statistic. But yeah, so some are found against us occasionally, and we deal with those immediately. We self-report as well. We self-report. You know, that might sound odd, and it might sound shocking, but in a regulated business, you have to self-report. If something goes wrong, you report it to the FCA immediately. If you do not, you are in for the high jump when they find out. So in a way, we're very open, and we talk about issues, and a lot of the noise that comes out from our communications is by being upfront and dealing with things before they go wrong and not brushing them under the carpet. So yeah, we've had a modest number of complaints. A number of people have taken them back. A handful of people we've just dealt with and put it right. But we tend to spot it. We uphold some complaints internally as well and deal with those internally. They don't go to the FOS. And a number of these complaints get put into the FCA. They get thousands, millions, who knows how many millions of complaints they get from consumers. And I mean, we do know because there's statistics they publish, but it's big numbers. But we don't get very many, and they absolutely read them, and they absolutely question us about them. But the FCA isn't some arm's length organisation that doesn't have the foggiest what's really going on. It might look like it at times from outside, but no, they really understand our business. And when somebody asks a question, they absolutely put it into the next call. They might even contact us specifically about it to look into it further. But there's never any surprise. If there was anything wrong, we would have already reported it to the FCA. You have to self-report. No choice. If you don't, yeah, as bad as a jail cell beckons. So it's a pretty serious matter, not running a regulated firm correctly.
Okay, so Dale Potter has asked, knowing what you know now, Stuart, would you have done anything differently in your response to what happened in March 2020 when the COVID first hit?
If we'd have known how it would have played out, we would have enjoyed being able to tell people the roadmap of what we would do. But assuming we couldn't see into the future, and now just what we know now, what would we do differently? I reckon we probably got 90% right within reason, and 10% could have been better for sure. That's what the scorecard would probably say. But people notice the 10%. They don't tend to notice the 90. So some people got very upset about a few things, and rightly so in their perception of what was going on. Their perception is absolutely reality, and it didn't work out as they wanted. And yeah, what would we have done differently? I'd have done all the same things to get us to that point when it hit. So the quality of team and everything else, what would I have done differently? Yeah, we've looked at it. We've learned a little bit. We've refined, and we've sent an email out about this, the learnings. But it includes things like tighter control and automation on the access account liquidity and other numbers, so that we didn't need to introduce one or two things we'd never needed before in the middle of the cycle. So what would we have done differently? We'd have absolutely introduced the secondary market. We'd have absolutely introduced fees. We would have attempted, I think what would we do differently? We'd attempt to communicate better. Whether we could and please everybody, I don't know. But we would certainly try that. But in terms of the actual business things that we did the right things, I believe, on pretty much across the board, made very, very few mistakes on the business side, and came through this strong in the end, and protected people's investments, protected their capital, and carried on paying a healthy interest rate. So yeah, we've got a whole bunch of learnings. We contemplate our navels all the time, and we challenge each other, and we always say, well, okay, but that's all well and good, but what are we going to do different now based on what we know? So it's like a continuous learning. There's a method in management called key learning points, KLPs. It's a thing drilled into me. I went to a military training school, not because I'm ex-military, but because that's the sort of thing I do. And it was an ex-military school that did management training, and my goodness, did that drill that into me. Whether I was up a cliff, down a mine, or in a river, or whatever I was doing, or in a classroom, it was drilled into me. How you run businesses, how you run projects, how you run is continuous improvement, key learning points. What would you do more of again? What would you do less of again, or never do again? And what must you always bear in mind? What's interesting? It's a de bono thinking thing, plus minus interesting, but it's also a key learning points structure. You always, at the end of every step, re-review what you've done. You look at what you do more of, what you must always do in the future, what you must never do in the future, and what you must always bear in mind. And that list has grown in the last year for this type of business, and that's with people who've got experience of decades in lending, in credit, because it's when you join all the parts up to form a P2P platform that's when you get the surprises, because it's a new industry.
Yeah, absolutely. We've been going for about an hour and 22 minutes. I don't want to keep you on here for too long, because I definitely appreciate your time, and I know there's a few more questions that people have, and I want to give you a chance to kind of tell us about anything else that Assetz has going on. So we'll kind of run through these real quick, and let's see here. Mike Powell says, are there any loans you really regret that you wish you just hadn't have done?
Yeah, well, yeah, every one that's defaulted, which isn't too many, but of course you regret doing them. But would you have done them differently is the actual correct question, and all professional lenders always ask that. And what you've got to be able to do when you're vetting a loan to lend is, would you look back and think, I can't justify that, that was a mistake, and that actually isn't the case. So yes, of course, you regret every loan that's defaulted, but the key question is, would you have done it differently at the time? And it's only with the benefit of hindsight and so on, and that should never happen. Professional lenders should always be thinking ahead and then looking backwards, and that's how we do. That's how we think. So we're doing this loan. Have we done everything correctly? Have we done everything in a way where in the future we would question it and go, why didn't we do this as well, or why didn't we do that? And to the best of our ability, we do what we think is all the right things each time. But of course, there are some loans you wish you hadn't done, but you just didn't know why at the time. And you can say it was obvious, but it really isn't. It's let's put it another way. A lot of people think they can predict, for example, I don't know, the stock market, for example, and build an investing system. You've all seen Billions and the quants sat in the little glass box off to the side who mess with computer keyboards and try and make software predict the perfect answer every time and make billions. Well, it just isn't really that easy. It just doesn't really work. How those guys work, and they're rocket scientists, is they build models which, applying it rigorously and robustly over time, lets through a limited number of bad eggs. And on balance, the returns are much bigger than the losses. And that's our business. And if the biggest and the best, the multi-billion hedge funds of the world with infinite budgets for the best rocket scientists in the world still have a balance of winners and losers, and their only purpose in life is to make sure the pluses outweigh the minuses by a decent ratio, that's our job. And we would never lend to anybody if we thought there was zero chance of it defaulting at all. It's all about the probability of default. So there's a few loans that you look at and you go, with hindsight, gosh, I wish we hadn't done that. But what was it at the time? And when you're facing the facts at the time, then that's a pretty tough thing to do. There's a few learning points along the way, but not very many, considering we aren't learning credit with your money. We employ people with deep credit histories, credit careers. So we're not one of those businesses reinventing credit. So it's more likely it's statistical glitches in hunting out an imbalance of risk and reward in the SME funding world, where our total returns are way above zero. That's the net outcome. And the only way of getting there way above bank accounts is by taking some risk. So it's not good if it's a manual loan and you're in it and you're watching it and you've got a measurable amount of money in it, or any other way you've got measurable money in it. But the access accounts were designed to give us the best possible diversification, and they tend to give the smoothest ride.
Okay. Let's see. Roger Taylor wants to know, how about Assetz Exchange? How is that doing?
Yeah, so I gave an example of the care facility that we did for children recently, funding the development of that through Assetz Capital. But Assetz Exchange is a sister company, and as we begin to expose more about our purpose as a business group, it'll become much clearer how everything links together. So yeah, Assetz Exchange is growing quickly now. It's taken a few years to establish because it takes time to set a business up if you're doing it carefully, but it's now moving faster and faster. And what its speciality is typically, for example, funding properties which can be provided on long leases to charities to provide, for example, supported living facilities. We supply property in that business, for example, to a very big charity in Nottingham, for example, which provides housing for ex-prisoners to re-enter society. And that's a crisis. There just isn't enough housing. We're providing that to those people. We're providing funding to children's homes, learning difficulty homes, and so on. We want to have impact in those segments. They're massively undersupplied. Assetz Exchange is doing just that. It doesn't compete with Assetz Capital, because what Assetz Exchange effectively does is acquire long-term assets and pay long-term inflating income off long-term leases to charities and so on. Whereas Assetz Capital funds the building of those types of developments and maybe commercial mortgages for businesses running their own premises. So yeah, it's doing very well, and it's also going into the service plot custom build sector. It's very active in that. And I think one way of summing Assetz Exchange up is buy to let is dead, long live buy to let in its new form. And buy to let in its old form did a lot of good, brought a lot of housing to the market, but you're not going to win that argument. The country's turned against buy to let. And all that we do now is deliver housing through Assetz Exchange into the undersupplied sectors where vulnerable people need housing. And that's what we're doing in Assetz Exchange. Assetz Property, which was the earliest part of our group, actually was subject to a management buyout a couple of weeks ago. And so, yeah, we're not involved in the old buy-to-let world anymore.
Yeah.
It's all about high impact investment to drive the housing market and drive the undersupplied segments and to drive funding into SMEs. And Assetz Exchange is an important part of that group, and you'll see it higher and higher profile over the coming years.
Okay, good. One last question for you. Thumbs up or thumbs down? Bitcoin, what do you think?
I get it. You're talking to somebody who's owned mining rigs.
You Bitcoin mining rigs, you've owned those?
Yeah, absolutely.
Yeah, really? Okay, good.
Yeah, it's in the garage now, completely useless. But yeah, why do I own a mining rig? Why do I understand anything? I don't believe you understand anything truly if you don't do it. So yeah, buying a mining rig off Butterfly Labs in years gone by, I don't know when it was, about 2015, 16, I think, and understanding exactly what blockchain is, understanding exactly what Bitcoin is. If you don't understand something, how can you comment on it? Mm-hmm. So yeah, understand that. It's a thumbs up, but only in one sense. I've got a big downer on it for various reasons. It's completely non-eco, it's anti-climate change and all the rest. This is a store of wealth that's probably made it, but it's definitely not currency. And understanding its technical makeup, I don't think it will make it as currency. I think it's a place for people to put money that's got extremely limited supply. It's quite clever how it's been constructed, and the value will just keep going up and up and up and up and eventually level off. Where will it level off? No idea. I'd estimate somewhere between 1 million and 10 million per Bitcoin in years and years to come. There you go. I think it's just what it is. It's a pure outright speculation.
Now, were you lucky enough to keep any of those coins that you mined from that rig? That's what I want to know.
No comment.
Hopefully, yes. Hopefully, you did get to keep some of it.
It's just one of the many things. It's one of the many things. If you don't understand, look at my books. I've got a bookcase full of banking books. I'm not a banker.
Yeah.
Everybody in my business is a banker, near enough. I'm not a banker. I read banking books. I want to understand more than they understand. I want to know exactly how the money really flows. And the books don't always tell you the truth either. Mm-hmm. So you have to read, and then you have to get to a point where you understand, and then you can pass judgment, and then you can actually say useful things and challenge people.
Right.
So yeah, same with Bitcoin. Yeah, thumbs up, sort of. It's probably made it.
Yeah, I'm a big believer in the future of it. I definitely don't think it's going to be a currency, but I always say digital gold is what Bitcoin is going
It
to be
is.
in the future, and I've
It is.
always been, well, not always, the last few years I've been a believer in it. We'll take one last question, and then I'm gonna let you say anything else that you want to say about assets. Totally appreciate your time. We've been on here for, God, probably a little bit too long. We've seen all of these failed companies now, and a lot of people ask, why do companies like Assetz Capital not come in and try to save these other companies that are struggling or closing their doors? Have you considered taking any of the loans from administrations?
It was the old question, and actually it answers one of your other points earlier as well. So it's always been the same. We don't want those loan books. The loan books of the failed companies are often really not a good idea to go anywhere near. So what is it exactly we're buying?
Yeah.
And we're just taking on a huge problem. We won't get paid for it very much, and it'll just cause chaos and divert us from our strategy. There aren't many people doing property-backed secured lending of our type. So firstly, we'd have to either diversify and go into other markets, which we'd already have a strategy for if that was a real intent. And secondly, it's probably a bag of spanners, frankly, which is partly why it's fallen over. So no, and my point over the years has always been the same. I don't believe there'll be any material consolidation. There'll be a few takeovers here and there, but on the whole, I expect the businesses to close, not be bought and consolidated. And that's exactly what's panned out. So I've been saying that for years, and that's exactly what's happening. Because who wants to take over that type of problem? You just don't know what you're buying.
Yeah.
I mean, just how long it takes the administrators to figure out what people have been up to no good with in one or two of these names. And imagine if you bought the thing, cheapers, you paid money to find that problem.
Yeah. So that's why
crazy. At least the administrators are being paid to find the problem. We would have paid to find it.
Steer clear of those.
Yeah.
Okay, so Stuart, anything else? We're going to wrap up in a minute. Anything else you want to tell people out there maybe considering dabbling in Assetz Capital that haven't before?
I would just take it easy, try us out, see how it goes, and then invest in due course. And the earlier you do your research, a bit like me with Bitcoin and anybody just doing their research, is the sooner you do your research, the sooner you can be more confident you've got proper data to make a big decision if you decide to put more money in later. Don't leave it till the last minute when you realize you're just not getting any return on your investments and you've got to make a panic decision. Go slowly, and there's nothing better than practical experience. So go slowly and do it, and decide who are you backing? Do you trust them? Are they aligned? Are you the hero? Are you the person who they're just a tool in the toolbox? That's all we see ourselves as. We're just helping people generate income, and by the way, doing it off having an impact on some really needy sectors. And so it's brilliant. Everybody should be really proud of what they've achieved through us, and helping fix the housing crisis and other specialist housing markets. It's great.
Yeah.
So yeah, I think we'll do more of that. In 2018, 2019, we funded an astounding 1 in 12 of all small, medium-sized house builder homes built in the country. 1 in 12. It's an astounding figure, and every time I look at it, I always redo the maths, and it's right. And in years to come, not that many years, hopefully, maybe we're funding 3, 4, 1 in 3, 1 in 4, 1 in 5 of all small, medium-sized house builder homes in the UK. Entirely possible, and you can be part of that. So it's about having a purpose, having a mission, and having fun doing it, and getting paid to do so, which is what our investors are. So that's all we're here to do. It's what gets us out of bed in the morning, and we're just trying to give everybody a good outcome, one way or the other, in balance.
Perfect. Okay, well, there you have it. That's Assetz Capital for you, and thank you again, Stuart, for showing up and being willing to answer the tough questions that I'm sure people wanted to throw at you. And if you want to sign up for an Assetz Capital account, I'll put the link down there. If you can use that link, it helps out the channel. And hit that thumbs up, subscribe, and Stuart, we'll have you back on hopefully in a few months. You can give us an update and let us know what's going on. Truly appreciate it.
Thanks to everybody for your support. You're having great impact, and please carry on doing it, and enjoy the ride. And thank you, Lawrence, for inviting me on. Available anytime, not quite as exclusive as you made out at the beginning. I'm around. It's my job.
Okay.
And obviously, with an IPO, I'd definitely be out there talking to people even more. So no, it's
Absolutely.
part of my job, and I like getting to the front line and hearing comments, hearing what people are saying, because in the end, we're a customer-centric business. It may not always look like it, but honestly, we are, and we know that's the only way to sustainable growth. So thank you again, everybody, for your support through this very difficult time, and we hope to serve you going forwards.
Okay. All right. Well, thank you, Stuart. You have a good evening. I'm going to sign off with you, and we'll look forward to speaking to you in the future. Truly
Thanks,
appreciate
everyone.
it. All right. Bye.
Lawrence, thanks,
Bye-bye.
everyone. Thank you.
So there you go. Assetz Capital, Stuart Law. I think it was a very interesting chat. Thanks again for your questions. Just a little news. We'll be back here next Thursday. Join the Facebook group. If you haven't subscribed yet to the new channel, please hit that red subscribe button. We're on a mission to get back to the 1,000 subscriber mark. As you know, the old channel was taken down. I know a lot of you have already subscribed, so I very much thank you for that. Appreciate that. You know, I don't know if you've seen too what's going on with the cryptocurrency world. You know, I've again been a big supporter of what's going on. I know we have a lot of naysayers, especially in the group, that think, oh, this crypto thing is just a whole bunch of hot air. But big things happening this week. We're seeing this secondary bull run of Bitcoin breaking through the $60,000 range, which I think is an important thing to pay attention to. For anybody that's interested in investing in cryptocurrency, be watchful and be mindful. We're going through a bull cycle right now that I think, if I had to make a prediction, is going to end at the end of 2021, possibly early 2022. And yeah, I think it's very interesting. We had Coinbase's IPO hit the Nasdaq this week. It's a huge deal. If you Google Bitcoin, you're going to see news stories and a lot of attention being thrown onto cryptocurrency right now, which is only, again, we're very early in this mass adoption stage, and people are always asking me, is it too late? Is it too late to invest in cryptocurrency and Bitcoin? And personally, I say no. You're still in the very early stages, and you heard what even Stuart said, that he predicts anywhere from 1 million to 10 million per coin in the future. We don't know if that's true or not, but again, I think it's really, really big what's happening this week, and you're just going to see, the next price target's probably in the mid $70,000 range, I think. Probably end of 2021, maybe at the $100,000 to $200,000 range. So it's definitely not too late. I've been continuing to buy myself and buy and hold. That's my strategy. So I just wanted to throw that out there because I think it's important news. And we'll be back next week as per normal. We will not have a guest. We've had 2 guests in a period of 2 weeks. I usually don't do that. I try to space them out a little bit. But just so happens Stuart had a free evening, so I wanted to get him on. And I think he answered a lot of questions. Sorry if I didn't get to all of them. Obviously, there's just so many questions and not enough time. We didn't want it to go on for too long for Stuart. So if you have any comments, put them in the chat. When we end the stream, I'll answer them, and we'll be back next week. Thank you for your time. Very much appreciate everybody being here, and we'll see you next week. Be safe out there. I know the country's starting to open up. Hopefully I'll be back in the UK soon. And much love to everybody out there. Take care, and we'll see you next week.